Hello, everyone. My name is Barbara Armstrong. I'd like to welcome you to this trade management mini session on the power of compounding. Part 2, I'm calling this, because there were some questions and comments that came up as a result of the first power of compounding mini session. And so this one is going to focus on automating your investing over time and the type of difference that can make. And I thought it was a really important addition to the first power of compounding. So here we go. Power of Compounding Part 2. If you're not following me on X, I invite you to do so. I'm posting content there on a daily basis that I think you will find informative and helpful at Barb Armstrong CS. Know that everything that we do in this little session is for general information purposes only and shouldn't be considered to be a recommendation on the part of Schwab or myself. We are going to be using a third-party tool today called investor.gov, and there are many tools like this available. This is just one example. So let's get out and have a quick look. And just know that I will also put a link in at the end of this session to the first power of compounding. So here we are on investor.gov. We're going to come to the compound interest calculator. And in the first session, and we went over this in detail, so I'm going to go over this part fairly quickly. Our initial investment was zero. So let's say you've just graduated from college. You don't really have a lot of extra money, but you're figuring you've got your first, full-time job. You're excited and, you want to move forward. Just one sec. Let me add my little camera in the corner here. Yeah, you're excited about that. And you're figuring you can save $5 a day. And $5 a day, that comes out to $152 a month. And we said, let's say, you're in your early 20s and you figure maybe you're 20 years old, you're going to retire when you're 67, or maybe you want to retire earlier, but you figure you won't need that money till you're at least 67. And so if we let it grow for 47 years, what might we choose as an interest rate? And so what I did there, and just let me grab my drawing tools. So what we did there was we said, okay, if we are assuming that over time, and we did this in the last session, the S&P 500, the average return over the last 30 years was 9.67%. And the average return of the NASDAQ 100 was about 14.65%. And this is over the last 30 years. And so I just added these two numbers up and divided by 2. And we came up with a return, an average annual return of 12.16%. And that was if you found, a mutual fund or an ETF or some type of investment vehicle, put half of it in an index that tracked the S&P 500 and half of it in an index that tracked the NASDAQ, which is a little more of a tech-heavy index and has no financial stocks. And that's where we would be. So we said, okay, our annual interest rate. So if you're wondering how I got this 12.16, that's how I got it. And there's a little more detail in the first video on that if you want to go back. And like I said, I'll put a link in. So if we went with that 12.16, and then we said, okay, how often are we going to compound this? And I put monthly in. And someone in the comments made a comment and said, well, you're kind of off in that, they thought it was compounding 12% a month, but it's compounding 12% over the year, but assuming that it's going to grow monthly and compound monthly. And so if you calculate that number, it comes out to 4.407. Now, why did I say so? $4.4 million, $5 a day with this type of return saved over 47 years. You know, it comes out to a huge number, doesn't it? Like it's kind of, I think it's kind of blows your hair back. But what if instead of saving monthly, you just said, you know what? I'm just going to leave the money in my checking account, and then I'm just going to transfer to my investment account a lump sum monthly. And I cannot tell you how many books have been written on the subject of investing and saving for retirement, and almost all of them will say, one, pay yourself first, and two, automate it. So if it comes right out of your account before it even hits your checking account, or the account out of which you put your funds that you live from, you know, it makes a big difference. So, but if I change this from monthly to annually, and then I hit calculate, that number, our total in 47 years drops by over $1 million, almost 1.2 million. And what causes that to happen? Well, if you invest monthly, if you think about it, if I bring, my little drawing tool back up, for 47 years, if you have automated it first, it's far more likely to happen. But if you have 12 months in the year and you've got, let me just bring this up again. If you've got January, you have money going in, and then February, you have money going in, and then March, and then April, and then May, and then June, and so on, that $150 is going to start growing. And then the money, the 150 that you deposit, that 152 that you deposit in February is going to start growing. And then the 152 that goes, it's $75 if you get paid twice a month. I don't have a twice monthly option here, and then 152, and then 152, and so on, as opposed to that 152 times 12, or that 1,824 that comes in at a lump sum at the end of the year. And so this monthly calculation represents what this number might look like. This is the number if you made a deposit once a year. But the reality is, what is the likelihood of this deposit happening in December? As opposed to if you just automatically set it up with your work to say, put this much into my 401k or some type of saving plan, and this is how I want it invested. And then you don't have to think about it. There's no to do. It just happens. And so I wanted to talk about that because I do a lot of research on financial literacy. It's a topic I am very passionate about. And one thing that I have heard repeatedly over the last 30 years is pay yourself first, and you will likely not miss it. And two, automate the process so that you don't have a to-do associated with it. Once you've set it up, it will happen automatically. And then your odds of actually doing it increase dramatically. I wanted to share one last little tidbit with you. And that is, and let me just, I say shake my Etch-a-Sketch, so kind of clear the screen. And I want to share some numbers with you. And this is a result of a survey done in 2022. A survey by the U.S. Federal Reserve, just so you know where I'm getting my numbers from. So the average retirement savings in the United States as of 2022 is 87,000. Now, it does vary dramatically by age. So if we look at age 55 to 64, that average goes up to 537,560. But the median is a lot lower. The median, which is if you lined up everybody's numbers and took the one in the very middle, that is 185,000. And at age 65 to 74, the average is 609,000. Actually, if you want to get really specific, 230. And again, the median here is much lower. It's 200,000. Which means that, you know, some people have saved a lot more, and then there's, you know, a lot of people that have saved, you know, a lot less than this average. But, you know, if you did this $5 a day and you can play with the numbers, you'd be way ahead of where the average person is facing retirement. And that's, you know, $5 a day. And some people might find that a stretch, but for a lot of people, it's just having the gumption and the knowledge to think, to set this up and to automate it and to go from there. So that's what I wanted to share with you today. I hope that you found it helpful. I hope that clarified a little bit of the way some of these calculators work. I appreciate you investing this time with me, and I encourage you to share this information in this video with those that are special to you, whether it's a neighbor, a parent, a friend, a brother, a sister, a daughter, a grandchild. As I said in my previous video, like my kids have all seen this multiple times, and it's just understanding the difference that this can make. So guys, have a really awesome rest of your day. I'll see you in a mini session coming up soon. Take care, everyone. Bye for now.